Bank audit. Banks have certain characteristics distinguishing them from most other commercial enterprises. Hint is are we cold? Are regulatory requirements by government authorities often influence accounting and auditing practices in the banking sector? V. Volume of monetary items. C. Complex accounting and internal control system. O. Off balance sheet items. L. Large volume and variety of transactions. D. Direct initiation and completion of transactions by the customer without any intervention by bank employees. So banks have certain characteristics distinguishing them from most other commercial enterprises. Hint is RV cold. Next, special audit considerations arise in the audit of banks because of a particular nature of risks associated with the transactions undertaken, the scale of banking operations, extensive dependence on IT, effect of statutory and regulatory requirements, continuing development of new products and services, and banking practices which may not be matched by the concurrent development of accounting principles and auditing practices. Next, evolution of technology and providing services through net banking and mobiles has exposed banks to huge operational and financial risks. Next, the legal framework. Principal enactments which govern functioning of several types of banks are Banking Regulation Act 1949, Reserve Bank of India Act 1934, SB Act 1955, Regional Rural Bank Act 1976, Companies Act 2013. Next, form and content of financial statements. Every banking company is required to prepare a balance sheet and P&L in the form set out in third schedule to the Act or as near thereto as the circumstances admit. Form A of third schedule to the Banking Regulation Act 1949 contains the form of a balance sheet and Form B contains P&L. Every banking company needs to comply with the disclosure requirements as per Section 133. For banking companies, Ind AS is not applicable. Ind AS has been deferred by RBI. In case of private banks, the process of accounting are centralized. That means in case of private companies, centralized accounting will be done and there is no concept of mandatory branch audit in accordance with RBI guidelines. So, branch audit is not mandatory for private banks. Audit of accounts and appointment of auditor. Most banks, especially those in nationalized banks or public sector, appoint four or more firm of chartered accountants to act jointly as statutory central auditors, depending upon their size and board decision as per RBI guidelines. The appointment letter sent by banks in connection with appointment of statutory central auditors typically contains period of appointment, particulars of other central auditors, particulars of previous auditors, procedural requirements to be complied with in accepting the assignment, statement of division of work and review and reporting responsibilities amongst joint auditors in case of nationalized banks. Generally, this is decided at a later stage. Scope of assignment, which includes any special reports or certificates to be given by the statutory central auditors in addition to the main report. In case of statutory branch auditors, appointment letter is given on similar lines except in regard to particulars of other auditors and statement of division of work. However, it is to be noted that statutory branch auditors is carried out by a single firm of chartered accountants. Statutory branch audit is carried out by a single firm of chartered accountants. Next, authority appointing the auditor. Generally, shareholders will appoint auditors with RBI approval. Nationalized bank. In case of nationalized banks, board of directors will appoint the auditors. Here, RBI approval is required. In case of SBI, auditors are appointed by CAG of India. In case of RRB, regional rural banks, auditors will be appointed by concerned bank with the approval of central government. Next, conducting an audit. The audit of banks or of their branches involves the following stages. There are 5 stages: initial considerations, understanding, risk assessment, execution, reporting. 5 stages. Initial consideration, understanding, risk assessment, execution, reporting. Initial considerations. In initial considerations, following activities will undertake: acceptance and continuance, declaration of indebtedness, terms of audit engagements, communication with previous auditor, planning, establishing engagement team. In case of understanding, following activities will take place: understanding bank and its environment, including internal control, understanding bank's accounting process, understanding risk management process. Management develops controls and uses performance indicators to aid in managing key businesses and financial risks. An effective risk management system in a bank generally requires following. Hint is micro. M. Monitoring activities. I. Information systems. Reliable information systems. C. Charged with governance. Oversight by those charged with governance. R. Risks. Identification, measurement, and monitoring of risks. A. Activities. Control activities. Next, risk assessment. Identifying and assessing risk of material misstatements, assess risk of fraud, including money laundering, assess specific risks. Next, execution. Engagement team discussions, prepare response to assessed risks, establish overall audit strategy, determine audit materiality, consider going concern. Reporting. Independent auditors report, long form audit report, report any other matter to bank, regulator, or government. Special considerations in IT environment. Sharing of information with auditors. Considering importance of IT systems in preparation and presentation of financial statements, it is imperative that bank should share detailed information with auditors like overall IT process and the structure of a bank's IT system, data processing and data interface under various systems, data integrity and data security, controls on recording of various e-banking and internet banking products, MIS reports and major exception reports and their process of generating various information related to disclosure in financial statements. Key security aspects that auditor needs to address. Key security control aspects that auditor need to address when undertaking audit in computerized bank include: ensure that authorized, accurate, and complete data is available for processing. Ensure that in case of power failure, system restarts without distorting records. Ensure that system prevents unauthorized amendments to programs. Verify that segregation of duties is ensured while granting system access. Verify that changes made in parameters or user levels are authenticated. Verify that exceptional reports are authorized and verified on daily basis. Internal control in certain selected areas. General areas of focus. General examples of internal controls in a bank. General: the staff and the officers of a bank should be shifted from one position to another frequently and without prior notice. The work of one person should always be checked by another person, usually by an officer, in the normal course of business. The arithmetical accuracy of the books should be proved independently every day. All bank forms, that is checkbooks, demand draft or pay order books, travel checks, foreign currency cards, etc., should be kept in the possession of an officer, and another responsible officer should verify the issuance and stock of such stationery. The mail should be opened by a responsible officer. Signatures on all the letters and advices received from other banks, other branches of the bank, and its correspondence should be checked by an officer with a signature book. The signature book and the telegraphic code book should be kept with responsible officers, and access should be allowed only to authorized officers. The bank should take out insurance policies against loss due to all the risks such as fire, natural calamities, theft, and employees' infidelity. The financial powers of the officers of different grades should be clearly defined. There should be surprise inspection of head office and branches at periodical intervals by the internal audit department. The irregularities pointed out in the inspections report should be promptly rectified. Cash. Cash should be kept in a joint custody of two responsible officers. In addition to normal checking by the chief cashier, cash should be test checked daily and counted in full occasionally by a responsible officer other than those handling the cash. Actual cash in hand should agree with the balance shown by the day book every day. The cashier should have no access to the customer's ledger accounts and the day book. This is an important safeguard as the bank managements are often tempted to use cashiers because of their shorter working hours as ledger clerks in the absence of regular staffs, etc. This can result in substantial losses to the bank. The counterfeit of cash receipt vouchers. Example counterfeits of pay-in slips lodged by depositors should be signed by an officer in cash department in addition to the receiving cashier. Payment should be made only after the vouchers, that is, checks, demand drafts, etc., have been passed for payment by the authorized officer and have been entered into the customer's account. Receipts and payment scrolls or their total should be compared with the cash column of the daybook by independent persons. High value cash receipts and payments should be verified by a higher officer or branch manager, and excess cash balance should be remitted to currency chest according to branch retention limit on daily basis. Next, bills for collection. All the documents accompanying the bills should be received and entered in the register by a responsible officer. At the time of dispatch, the officer should also see all the documents are sent along with the bills. The accounts of the customers or principals should be credited only after the bills have been collected or an advice to that effect received from the bank branch or agent to which they were sent for collection. It should be ensured that bills sent by one branch for collection to another branch of the bank are not taken in the bills for collection twice in the amalgamated balance sheet of the bank. For this purpose, the receiving branch should revise the entries regarding such bills at the end of the year for closing purpose. Next, bills purchased. At the time of purchase of bills, an officer should verify that all the documents of title are properly assigned to the bank. Sufficient margin should be kept while purchasing or discounting a bill to cover any decline in the value of the security. If the bank is unable to collect a bill on due date, immediate steps should be taken to recover the amount from the drawer against the security provided. All irregular outstanding account or accounts should be reported to the head office. In the case of bills purchased outstanding at the close of the year, the discount received thereon should be properly apportioned between the 2 years. Loans and advances. Banks should make advance only after satisfying about creditworthiness of the borrowers and after obtaining sanction from proper authorities. All necessary documents should be executed by parties before advances are made. Sufficient margin should be kept against securities taken to cover decline in value. All securities should be kept in joint custody of two responsible officers. All securities should be registered in the name of the bank. All accounts should be kept within drawing power and sanction limit. Additional temporary limit may be sanctioned for maximum 20% of the existing limit and 90 days tenure. All accounts which exceed sanction limit or drawing power should be brought to notice of the management regularly. Operation in each advance account should be reviewed at least once in a year. Next, demand drafts. The signatures on a demand draft should be checked by an officer with the signature book. All the demand drafts sold or issued by a branch should be immediately confirmed by an advice to the paying bank. If the paying bank does not receive proper confirmation of any demand drafts from the issuing branch or does not receive credit in its account with the branch, with that branch, it should take immediate steps to ascertain the reasons. Interbranch accounts. The accounts should be adjusted only on the basis of advices and not on the strength of the entries found in the statement of accounts received from other branches. Prompt action should be taken preferably by central authorities if any entries, particularly debit entries, are not responded to by any branch within a reasonable time. Credit card operations. There should be a system for effective screening of applications, strict control over storage and issuance of cards, prompt reporting by merchants of all settlements accepted through credit cards, ensuring statements are sent regularly and promptly to the customer, monitor and follow up customer payments, identification of payments overdue beyond reasonable period, periodic review of credit card holders account, compliance with CRR and SLR requirements. CRR, cash reserve ratio. CRR is a specified minimum fraction of total customers' deposits which banks have to hold as reserves either in cash or deposit with RBI. Statutory liquidity ratio SLR is the requirement that bank is required to maintain in the form of liquid assets such as gold and cash before providing credit to the customers. Audit procedure in case of CRR and SLR. Special points in audit of compliance with CRR and SLR requirements. Verify compliance with SLR requirements of 12 audits, not being Friday. Obtain understanding of relevant circulars or instructions of RBI. Examine consolidations regarding demand and time liabilities position prepared by the bank with related returns received from the branches. Examine whether consolidations prepared by the bank include information of all branches. In demand and time liabilities computation, examine following items is excluded from liabilities: paid up capital, reserves, and loan taken from RBI, part amount of recoveries from borrowers in respect of bad debts, amount received against import bills in Indian currency, unadjusted balances for agency business, margins held in sundry deposits for fund facilities. Similarly, examine following items is included in the liabilities: net credit balance in branch adjustment accounts, borrowings from abroad, verification of advances. Focus area: suggested at audit procedures. Suggested audit procedures. Focus area: substantive audit procedures. Verify correctness of the master data of loan accounts updated in CBS core banking solution. Check parameters like installments, EMI, rate of interest, tenure of loan, etc. Examine all large advances, while other advances may examined on sample basis. Examine identified problem accounts which are not yet slipped into NPA category. Examine accounts which are adversely commented by concurrent auditors or bank internal inspection or RBI inspection team. Examine restructured account list to ensure restructure is as per RBI guidelines. Verify completeness and accuracy of the interest charged. Carry out appropriate analytical procedures. Recoverability of advances. Review periodic statements submitted by the borrowers indicating compliance with terms and conditions. Review latest financial statements of the borrowers. Review reports on inspection of securities. Review auditors' reports of borrowings having credit facilities beyond cutoff limit. Verification of asset classification, income recognition, and provision per NPA. Classification and provision. Suggested audit procedures. Verify whether bank has a system of classification of advances through core banking solution without manual intervention. Examine whether classification made by the branch is appropriate. Examine whether secured and unsecured portions of the advances have been segregated correctly and provisions have been calculated properly. Review and compare date of NPA of loan accounts mentioned in current year statements with previous year. Reasons for any change should be ascertained. In case of accounts regularized near balance sheet date, as per RBI guidelines, if account has been regularized before balance sheet date by payment through genuine sources, account need not be treated as NPA. If subsequently branch has provided further funds to borrower, auditors should carefully assess whether repayment was out of genuine source or not. If account indicates inherent weakness, account should be deemed as NPA. Drawing power calculation. Ensure that drawing power is calculated as per the guidelines formulated by Board of Directors. Special considerations should be given to proper reporting of sundry creditors and stocks covered under LCs or guarantees for calculating drawing power. Drawing power needs to be calculated carefully in case of working capital advances to companies engaged in construction business. Stock auditors report should be reviewed and special focus should be given to comments made by stock auditors on calculation of drawing power. Accounts with temporary deficiencies. Banks should not classify an advance account as NPA merely due to existence of some temporary deficiencies, such as non-availability of drawing power based on latest available stock statement, balance outstanding exceeding the limit temporarily, and non-renewal of limits on due date. However, stock statements for determining drawing power should not be older than 3 months. Ensure adherence to these guidelines. Next, limits not reviewed. Accounts where regular or ad hoc limits are not reviewed within 180 days from the due date or date of ad hoc sanction should be considered as NPA. Ensure that ad hoc or short reviews are not done on repetitive basis. Asset classification borrower wise. Ensure that asset classification is borrower wise and not facility wise. If it is to be ensured that all facilities granted by a bank to borrower will be treated as NPA and not a particular facility which has become irregular. Next, government guaranteed advances. If government guaranteed advances become NPA, then income of such advance is recognized only when interest is realized, that is on cash basis. Central government guaranteed advances is treated as NPA only when central government repudiates its guarantee when invoked. State government guaranteed advances is treated as NPA if it remains overdue for more than 90 days. In case bank has not invoked central government guarantee, though amount is overdue for long, it should be duly reported in LFAR, long form audit report. Agriculture advances. Ensure that NPA norms have been applied as per crop season, short term, long term, on all direct agricultural advances listed in circular. For agricultural loans not specified in circular, ensure that identification of NPA has been done on same basis as non-agricultural advances. In case of short-term crop, it will be treated as NPA if loan outstanding is more than for 2 seasons. In case of long-term crop, it will be treated as NPA if loan outstanding is more than for 1 season. Next, restructured advances. Restructuring is an act in which a lender grants concession to borrower for reasons relating to borrower's financial difficulty. It may involve modification of terms of advances, including alteration of a installment amount or repayment period or rate of interest or sanction, etc. Banks may restructure the accounts classified under any categories. Banks cannot restructure accounts with retrospective effect. On restructuring, account will be downgraded from standard to substandard. NPS will remain in same category. Sale or purchase of NPS. In case of sale or purchase of NPS by banks, auditors should examine policy laid down by board of directors relating to procedures, valuation, and delegation of powers for sale or purchase. Only such NPA has to be sold which remained NPA in books for at least 2 years. NPA have been sold or purchased without recourse only. That is, entire credit risk associated with NPA transferred to purchasing bank. Subsequent to sale of NPA, banks does not assume any risks relating to sale of NPA, sold NPA, sold NPS. Next, NPA has been sold at cash basis only. Banks has not purchased an NPA which it had originally sold. That means bank should not purchase same NPA which has earlier sold by the same bank. Next, special points in case of sale of NPA. NPA has been removed from books of selling bank after sale. If sale below net book value, shortfall will be debited to P&L account. If sale is more than net book value, excess will be utilized to meet a loss on sale of other NPA. Special points in case of purchase of NPA. Provision should be made for NPA purchased as per classification status in books of purchasing company, purchasing bank. Any recovery from NPA purchased is first adjusted against its acquisition cost and excess has been recognized as profit. For capital adequacy, banks assigned 100% risk weights to NPAs purchased from other banks. Next, verification of capital and liabilities. Capital. Capital is divided into two tiers, Tier 1, Tier 2. Tier 1 capital consists mainly of share capital and disclosure reserves, and it is a bank's highest Quality capital because it is fully available to cover losses. Tied to capital consists of certain reserves and certain types of subordinated debt. Loss, loss absorption capacity of Tier 2 capital is lower than Tier 1 capital. Capital risk adequacy ratio CAR equals to eligible total capital funds divided by risk weighted assets and off balance sheet items into 100. RBI requires banks to maintain minimum CAR of 9%. Borrowings. Obtain and verify confirmation certificates and other documents. Comply with the requirements of SA 505. External confirmations. Examine whether clear distinction is made between rediscount and refinance. Examine whether borrowings of money at short notice are properly authorized. Bills payable. Evaluate existence and effectiveness of internal controls over bills payable. Such controls should usually include following: draft, mail transfers, etc. should be made out in standard printed forms. Unused forms should be kept under custody of responsible officer. Bank should have a reliable private code known only to responsible officers. Signatures on demand draft should be checked by officer with specimen signature book. Examine sample of outstanding items in bills payable with relevant relevant registers. Relevant registers. Verification of contingent liabilities. Disclosure requirement. Disclosure requirement of contingent liabilities for banks. Claims against the bank not acknowledged as debts. Liability for partly paid investments. Liability for outstanding forward exchange contracts. Guarantees given on behalf of the constituents in India and outside India or outside India. Acceptances, endorsements, and other obligations. Other items for which bank is contingently liable. Management representation. Auditors should obtain representation from the management that all off-balance sheet transactions are accounted in books when such transaction has taken place. All off-balance sheet transactions are entered after following due procedures. All off-balance sheet transactions are supported by underlying documents. All year-end contingent liabilities have been disclosed. Disclosed contingent liabilities do not include any crystallized liabilities which require creation of provision in financial statements. Audit procedure. Test completeness of recorded obligations. Review reasonableness of year-end amount of contingent liabilities. Review minutes of board meetings, contracts, agreements, and list of pending legal cases to identify claims against bank. Ascertain status of claims outstanding at end of year from management. Verify outstanding forward exchange contracts with statements generated from bank accounting system. Ascertain whether there are adequate internal controls over issuance of guarantees and unused guarantee forms. Evaluate adequacy of internal controls over issuance of letter of credit. Verify balance of letter of credit from a register maintained by the bank. Next, claims against the bank not acknowledged as debts. Examine the relevant evidence. Example, correspondence with lawyers, others or claimants, workers or officers, and workmen or officers unions. Review the minutes of meetings of the board of directors or committee of a board of directors, contracts, agreements and arrangements, list of pending legal cases and correspondence relating to taxes and duties, etc. to identify claims against the bank. Ascertain from the management the status of the claims outstanding as at the end of the year. A review of subsequent events would also provide evidence about completeness and valuation of claims. Next, audit reports. Reporting to central government. In case of nationalized bank, auditor is required to make a report to central government in which auditor should state following: whether balance sheet contains all necessary particulars and is properly drawn up so as to exhibit a true and fair view of affairs of the bank. In case auditor had called for any explanation or information, whether it has been given, whether transactions which have come to auditor's notice are within powers of the bank, whether returns received from branches of bank have been found adequate for audit, whether profit and loss account shows true balance of profit or loss per period covered, any other matter which auditor considers to be brought to the notice of central government. Reporting of matters covered under Companies Act 2013. The auditor of a banking company is also required to state in report the matters covered by Section 143 of Companies Act 2013. Auditors' report should also include their views and comments on the following matters, namely whether company has disclosed impact of pending litigations in financial statements, whether company has made provision for material unforeseeable losses on contracts, whether there has been any delay in transferring amounts to investor education and protection fund by the company, whether dividend declared or paid by the company is in compliance with the Companies Act 2013, whether company has used such accounting software for maintaining its books, which has a feature of a record of audit trial facility, and same has been operated throughout the year. Reporting requirements relating to company auditors CARO 2020, company auditors reporting order 2020 are not applicable to a banking company. That means CARO 2020 is not applicable to banking companies. Long form audit report LFAR. Long form audit report is to be given by statutory branch auditors as well as statutory central auditors. LFAR for branch auditors is in form of questionnaire where observations or comments have to be provided on range of matters including cash, balance with bank, investments, advances, etc. These are submitted by statutory branch auditors to statutory central auditors. Consolidation is done at head office level and LFAR for bank is submitted by statutory central auditors to management. Copy of LFAR together with broad broad views together with board views or directions is submitted to RBI within 60 days of submission of LFAR by statutory auditors. Other reports and certificates. Statutory Central Auditor also provides reports and certificates on following: report on operating effectiveness of internal financial controls or financial reporting, a report on compliance with SLR requirements, a report on whether treasury operations conducted as per RBI instructions, a report on instance of adverse credit deposit ratio in rural areas, certificate on reconciliation of securities by bank, certificate on corporate governance. Next, concurrent audit. What is the meaning of concurrent audit? Concurrent audit is an audit or a verification of transactions or activities of an organization concurrently as the transaction or activity takes place. It is not a pre-audit. Concept in this audit is to verify authenticity of transactions or activities within shortest possible time. It is similar to internal audit. Scope of work, scope and coverage. Detailed scope of concurrent audit and coverage of branches should be determined by inspection and audit department of the bank with approval of audit committee or board of directors. Guidelines issued by RBI cover all key areas of activities of branch which is under concurrent audit. Following areas are covered by these guidelines: cash, deposits, advances, investments, foreign exchange, housekeeping, and other items. Focus areas, advances. Audit procedures are focus areas in case of advances. Ensure that loans and advances have been sanctioned properly. Ensure that securities have been received and properly registered. Ensure that post disbursement supervision and follow up is proper. Check whether letter of credits issued are within delegated power. Check whether bank guarantees issued are properly recorded in register. Ensure proper follow up of overdue bills of exchange. Verify whether classification of advances is done as per RBI guidelines. Foreign exchange. Audit procedures are focus area in case of foreign exchange transactions. Check foreign bills negotiated under letter of credit. Check whether inward or outward remittance have been properly accounted. Examine extension and cancellation of forward contracts for purchase and sale of foreign currency. Ensure that balances in nostro account in foreign currencies are within limit. Ensure adherence to guidelines issued by RBI about dealing room operations. Ensure reconciliation of nostro and vostro account balances. Appointment of concurrent auditors. Concurrent audit can be done by bank's own staff or external auditors. If bank has engaged its own officials, they should be experienced, well trained, and senior. They must be independent of the branch when concurrent audit is to be conducted. Audit committee of bank, board of directors of the bank, shall decide maximum tenure of external concurrent auditors. Generally, it shall not be more than 5 years. However, no concurrent auditor shall continue with a branch for more than 3 years. If any serious irregularities are noticed in working of the external concurrent auditors, their appointment may be cancelled and fact may be reported to RBI and ICAI. Reporting system in concurrent audit. There should be proper reporting of findings of concurrent auditors in structured format. There should be zone-wise reporting of findings of concurrent audit to audit committee of board of directors of the bank. Before submission of the report, auditor should discuss important issues with the branch manager. Minor irregularities are to be rectified in a timely manner. Serious irregularities should be reported to head office for immediate action. If fraudulent transactions are detected, they should immediately be reported to Inspection and Audit Department of the bank, Chief Vigilance Officer, and concerned branch managers. Follow-up actions on concurrent audit reports should be given high priority.